The card is on the counter, and the pen is already in your hand. Your mother is sitting next to you at the bank, and she's just said the most reasonable sentence in the world. Let's put Lisa's name on the account so she can pay my bills if anything ever happens to me. The teller slides the signature card across. There's a second line now, right under hers, waiting for your name. It feels like the responsible thing. It feels like love. So you sign. Here's what nobody at that counter tells you. The moment your name goes on that line, you didn't get access to your mother's account. You became an owner of it. And that one word changes everything, because from that second on, your mother's entire life savings is exposed to your life. If you ever get sued, if you ever go through a divorce, if you ever owe a debt you didn't see coming, a creditor can reach into that account and take her money. And the day she needs a nursing home, Medicaid is going to look at that same account and count every dollar of it as hers. Now don't go calling the bank in a panic to rip your name off. That can cause its own problem, and I'll show you why. Stay with me. There's a right way to help your parents with their money, and it almost never involves the word joint. Let me show you the machine first, and then the fix. Let's put your family exactly where they're standing, because the whole trap lives in one misunderstanding. Picture your mother, 74, sharp, still handling her own checkbook, but tired of the paperwork. She's not asking you to take her money. She'd be horrified if you thought that. In her mind, she's handing you a key so that if she's ever in the hospital, the lights stay on and the mortgage gets paid. To her, a joint account is just access, a convenience. That's even what the bank calls it. Now picture you. You've got a life, a car in traffic every morning, maybe a business, maybe a marriage, maybe a mortgage of your own, all of it perfectly fine today. But you carry the ordinary risk every adult carries, a fender bender with a lawsuit behind it, a business partner who defaults, a marriage that doesn't make it. And here's the part nobody warned you about. The day you became a joint owner of your mother's account, all of your risk became her risk. Your creditors are now standing one step away from her savings. That's the two-body part of this. Your mother thinks she gave you a key to a door. What she actually did was put your name on the deed to the whole house. She lives the intention, helpful, careful, loving. You live the exposure. And the cruelest version of it is the one where you did nothing wrong at all, and her money still walks out the door because of something that happened in your life. So here's what actually happens, in plain language, because once you see how a joint account really works, the right move becomes obvious.
When you add your name to your mother's account, the law doesn't see a helper, it sees a co-owner with full rights to every dollar in it. And that single fact opens 3 doors at once. Door 1, your creditors. A joint account between a parent and an adult child gets none of the special protection that, say, a married couple's account gets. The rule in most places is blunt. A creditor of any owner can garnish the entire balance, not your half, not the part you put in, all of it. So if a court ever enters a judgment against you, your mother's savings is fair game, even though she earned every cent of it. You can try to prove to the court that the money was really only ever hers, but the burden is on your family to prove it, in the middle of the worst possible week. Door 2, Medicaid. This is the one that ties straight to her care.
When your mother applies for long-term care Medicaid to cover a nursing home, the state looks at that joint account and by default presumes 100% of it belongs to her. Every dollar counts against her asset limit, even the money you deposited. To pull your share back out of the count, you need indisputable proof, deposit slips, withdrawal records, a paper trail showing exactly whose money was whose. Most families don't keep that, and there's a sharper edge hiding in how the account is titled. If it's an or account, where either of you can act alone, simply adding your name usually isn't treated as a gift.
But if it's an and account, or if you start moving money around or retitling it near the time she applies, Medicaid can treat that as a disqualifying transfer of the whole balance, and hit her with a penalty. Months where Medicaid pays nothing, right when she needs it most. Door 3. Her will. This one surprises even careful families. A joint account almost always comes with something called right of survivorship. That means when your mother passes, the account doesn't go where her will says. It goes to the surviving owner, you. automatically, outside the will, before a single other wish is honored. So if her will splits everything evenly between you and your two siblings, but your name is the only one on the big account, that money is legally yours alone. Her will never touches it. Families have been quietly torn apart by exactly this, and the parent who set it up never meant a word of it. One signature, 3 doors, and your mother thought she was just handing you a key.
Let me tell you about a family who found all this out the hard way, because this is where it stops being a list and starts being a kitchen.
Carol was 76, widowed and proud that she still ran her own money.
Her daughter Beth helped with the bills, so they did the sensible thing everyone tells you to do. They walked into the bank and put Beth's name on the account. Convenience, just in case. For 2 years, nothing happened because nothing needed to. Then 2 things happened at once. Beth was in a car accident, the kind where the other side's lawyer comes looking for money. And that same winter, Carol had a stroke and needed full-time care.
Beth sat down to do 2 things she thought were unrelated: defend the lawsuit and apply for her mother's Medicaid, and discovered they were the same account, exposed on both ends. The lawsuit could reach Carol's savings because Beth was an owner, and Medicaid counted the whole balance as Carol's because she was too, delaying the coverage the family was desperate for. Beth told me the thing that haunted her. She'd added her name to help. That was the entire reason. And that same signature was now the reason her mother's money was exposed to a stranger's lawsuit and her mother's care was on hold. Nobody in that story set out to hurt anyone. Beth was trying to help. The bank was offering a service. The lawsuit had nothing to do with Carol at all. And one signature was still all it took to pit a stranger's claim and her own mother's care against the very same account. Carol's joint account was set up out of pure love, and it still put her savings and her care in danger at the same moment. So let's make sure yours never does. This is the shield.
The good news is that almost everything a joint account was supposed to do for your family, you can get in a safer way. You just have to stop using ownership to solve a problem that only needs access. 3 moves. Move 1. If the goal is for you to pay your parents' bills, use a tool built for that, not joint ownership. The cleanest is a durable power of attorney. It lets you act on your parents' behalf, write the checks, handle the bank, everything, without your name ever going on the account as an owner. Your risk stays yours, their money stays theirs. Some banks also offer a true convenience account, or let you be an authorized signer, where you can transact but you're not an owner and you get nothing when they pass. If a joint account is truly the only option, make it an or account, never an and keep clean records of whose money is whose. Move 2. If the goal is for you to inherit the account, don't add your name. Name a beneficiary. A payable on death designation does exactly what parents think a joint account does, but safely. Your mother stays the sole owner her entire life, so your creditors can never touch it, and Medicaid isn't looking at your name on it. Then, the moment she passes, the account goes straight to whoever she named, outside of probate, no delay. It's a form the bank hands you for free. And unlike a joint account, it doesn't accidentally cut your siblings out, because she can name all of you. Move 3. If your name is already on a parent's account, do not walk in tomorrow and yank it off. I mean that. Retitling or moving money in the wrong window can create the exact Medicaid transfer penalty we just talked about. Instead, make the one document that fixes everything downstream. A clear record of whose money has actually gone in and come out of that account. That paper trail is your defense against a creditor and your proof to Medicaid, and it's the first thing any elder law attorney will ask you to build before touching a thing. Do those 3, and your parents get all the help they wanted and none of the exposure they never signed up for. Now the honest edges, because I'd rather you hear them from me than from a caseworker or a judge. Not every joint account is a 5-alarm fire. An OR account, used carefully, with good records, is far safer than an AND account. And for many families, a small bill-paying account is a manageable risk. The danger scales with the balance. It's the big account, the life savings, the house sale money, that should almost never have a second owner's name on it. And the rules vary. Whether the whole balance is truly countable, whether your records are enough to rebut it, how your state treats survivorship, what a convenience account even means at your particular bank, all of that shifts by state and by institution. The 100% countable rule can be pushed back with indisputable proof, but indisputable is a high bar, and the burden sits with your family. So don't tear a name off an account, and don't move money on the strength of a video. Any single one of those doors is enough on its own. 1 hour with an elder law attorney in your parent's state, before anything is signed or unsigned, costs far less than a lawsuit or a month of care nobody planned to pay for. So come back to that bank counter and the card with the second line waiting for your name. Helping your mother and protecting her aren't opposites. You can do both, but only if you help her in the way that keeps her money hers, with the right tool, not with your name on her account. That gets decided in the few seconds before the pen moves. Decide it there, on purpose, instead of leaving it to a creditor or a caseworker to decide for you years later. You don't need a lawyer tonight, and you don't need to sign a thing. You need one piece of information. Go find out whose name is on your parents' accounts and why. If you're already on one, you're not in trouble, you just have a record to start building. And if the conversation hasn't happened yet, ask the gentle version. If you want me to be able to help with your money, let's make sure we do it the way that protects you, not the way that exposes you. That one question is where every bit of protection on this starts. Your parents spent a lifetime making sure you were taken care of. If this helped you take care of them back, hit subscribe. I put out a new one of these twice a week, and I would always rather you have the shield before you need it than after. And if you know another family where a parent is about to just add one of the kids to an account, hit like, because that's the only way this reaches them before the pen touches the card. A joint account only becomes a trap when nobody understands what they signed. Now you do. Your family isn't walking into this one blind. I'll see you in the next one.